Hi, everyone, and welcome to the presentation on Are You Financially Healthy? For today's discussion, we'll be talking about financial health, what it is and why it's important. We'll also be looking at tips and tools that you as members can use to help you through this journey. And lastly, we'll be looking at other considerations and resources that are available to you as you go through this. Financial health is a term used to describe the state of your personal financial situation. It is multidimensional in the sense that it can cover many aspects, such as the amount of savings you have, how much you're putting away for your retirement, or other financial goals. Since we all have different lifestyles, different financial goals and circumstances, how you define financial health will be unique to you. For example, if you do not like debt and your priority is to be debt-free, to you financial health may be paying off your mortgage. If you're struggling to make ends meet, then maybe having a positive cash flow may be a sign of financial health to you. As your priorities change, the indicators and measures of financial health change too. That's why it's dynamic in nature. So why is your financial health so important? Financial health impacts your overall well-being, physical, mental, and social. You can't put your finances into one silo and your health into another. The two are interconnected. If your personal financial situation is not healthy, this can lead to problems in other areas of your life. And by the same token, if your physical or mental health are not good, this can lead to financial difficulties. So it's very important that you take a holistic approach to your well-being and factor in both components, the financial and non-financial. There are a variety of tips and tools you can use as you explore your financial well-being. In particular, today we're going to talk about the various stages of one's life from a financial perspective, discuss general planning processes one would go through to achieve a milestone in their lives, including retirement, and then lastly, focusing on how you might choose a financial advisor to help you through your financial journey. There are 4 stages of your financial life. Your savings period may begin as early as your youth, when you work casually delivering papers, or cutting the neighbor's lawn, or in my case, working at the local golf course. You saved all or part of your income from these jobs for a particular purpose. As adults, when we enter the workforce, we save part of our money we earn for short-term goals such as paying off our student debt, or long-term goals such as retirement. The savings period typically continues for as long as we are gainfully employed. Once retired, our focus changes from savings to spending, and our savings period dwindles down or completely ends. In this stage, tax strategies to maximize your savings are very important. The management period is when you build your savings, and you need to manage your assets. The management period is the longest financial stage of your life. It runs concurrently with the savings period and continues on for the remainder of your life, even after retirement. In this stage, investment strategies are critical. The spending period is where the fun begins. In retirement, you no longer have to save, but you can start spending some of your hard-earned money. In this period, you may be faced with constraints and restrictions. The constraints may be self-imposed when it comes to your personal savings outside of the pension plan. The STRP provides you with a lifetime pension, but if you're supplementing this income by your personal savings, then you may have a finite amount of savings to last you for the rest of your life. The restrictions may be placed by various tax rules or pension legislation. Understanding what you can and cannot do under these rules plays an important role. Your legacy is the last stage of your financial life. After you're gone, should you wish, you can leave wealth with your heirs. Some people may prefer to spend all their wealth during their lifetime. Others may prefer to leave a legacy behind. Depending on your wishes, you may structure your estate accordingly during your lifetime. No matter what you're trying to do in life, the general planning process can be useful. The first thing you need to know is where you are today. The answer to this question will come with you spending some time determining your personal balance sheet. Once you know where you are, you can now figure out where you want to go. This could be simple as buying a house, saving for your kids' education, or even saving for retirement. The next step is figuring out how much money you need in order to achieve your goal. This is where developing a comprehensive budget will be important. The last step, and probably the hardest one, is to determine how you're going to get there. We are now going to look at each of these separately. A balance sheet is a snapshot picture of your assets and liabilities, captured in a given moment in time. As a result, it is static, and does not tell you a lot about your financial position will be over time. It does have 2 key uses. Firstly, it helps you identify the types of assets you have so you know which assets you'll dip into first to finance your retirement. Secondly, it allows you to qualify the direction of your net worth. As you approach retirement, you want your balance sheet or net worth to take a positive direction. In order to give you a sense of what a balance sheet might look like, I've provided you an example. Although this is a simplified example, it does outline the main areas of focus. On the assets side, it's important to distinguish between your current assets, such as cash or savings, your non-registered assets, such as real estate, your registered assets, such as RSPs, and your personal assets, such as your house. I should note, though, that in order to reflect your pension on your balance sheet, you can't use the monthly pension that you've accumulated, but rather the commuted value of that pension. The commuted value can be obtained from your financial advisor and would fall under the registered category of assets, since it would be tax sheltered. On the liability side, you want to make sure that you outline your current liabilities, such as your credit card debt, lines of credit, and your long-term liabilities like mortgages and personal loans. In order to calculate your net worth, all you need to do is take the total of all your assets minus the total of all your liabilities. As mentioned before, this number will change over time. Now that we have your balance sheet in order, let's talk about budgets. Establishing a budget can be a useful tool. It is your personal income statement, and unlike a balance sheet, it takes into account your future plans, so it is dynamic in nature. It quantifies your standard of living and can help you set your retirement income target. Let's look at an example. To create a budget, you need to start with your gross income before taxes and other deductions. Next, you will need to list all of your expenses, including your savings, payroll deductions, income tax, and other expenses. In this example, we are assuming this teacher has a gross income of $80,000 and has an income tax deducted of $18,000. With payroll deductions of $5,000 and savings of $10,000, this leaves our teacher with $47,000 of disposable income to spend on things such as housing, transportation, living expenses, and personal expenses. The key thing to remember is that while you're working, you just need to ensure your disposable income is sufficient enough to cover off of all your expenses. So you could say that we have a top-down approach in these years. We are now going to take what we learned from the general planning process and turn our attention to retirement planning. To keep things simple, we've broken it down into 4 easy steps: creating a budget, setting a retirement income target, identifying sources of income, and lastly, determining how much personal savings you might need. Similar to the general planning process, one of the first steps in retirement planning is to create a retirement budget. In order to get started, you will want to gather some personal documents such as your most recent T4 slip or pay stub, your property tax receipt, your vehicle insurance, a list of your bills, your RRSP or TFSA contribution receipts, and your latest notice of tax assessment. Now that you have your documents gathered, you will want to summarize all your current expenses in order to get a good grasp on what your current spending levels are. Remember, the total of all your expenses, including payroll deductions and savings, must add up to your gross income. To create a retirement budget, you must determine how each of your current expenses will change once retired. At this stage, it is very important to divide your retirement expenses into categories of must-have, nice-to-have, and luxury-to-have, so you know where the trade-offs will need to be, if there is any at all. And lastly, it is extremely important that you monitor your retirement budget over time and make adjustments when necessary. How much money you need in retirement is a personal decision as it relates to the lifestyle you wish to maintain. In retirement, some expenses such as STF fees, CPP and EI contributions, and other payroll deductions, including pension contributions, will disappear, while others may increase or decrease depending on your personal circumstances. On average, it is reasonable to expect that in retirement, a lower income may meet one's needs. However, as your needs vary between individuals, a good place to start is to assess your current living expenses and give some thought as to how they might change in retirement. Now let's revisit the sample budget and help our teacher create their retirement budget. Starting from the bottom up, our sample teacher has gone through each of their expense categories and determined how each would change in retirement. For example, since they plan on traveling more in retirement, their personal expenses would likely go up $5,000 from what they are today. However, their transportation costs would likely go down since they wouldn't need to drive to work every day. When it was all said and done, our teacher was determined that in order to achieve their expected lifestyle in retirement, they would need approximately $41,000 of disposable retirement income in order to meet their needs. Adding back the income tax into the equation, our teacher would need approximately $50,000 of gross retirement income. Once your retirement budget is set, you can now focus on your retirement income target. Recall that before retirement, our sample teacher was being paid a gross income of $80,000, which equated to a disposable income of $47,000. After retirement, this teacher was expecting to only need a gross income of $50,000 or a disposable income of $41,000 in order to meet their retirement needs. An individual's retirement income target is really defined by their expected replacement ratio. A replacement ratio is the ratio of your total income in retirement from all sources divided by your last year's salary. If we're looking at gross income, our sample teacher has a replacement ratio of 63%. However, gross income is likely not the amount you should be focusing on to set your retirement income target, but rather your disposable income. Looking at disposable income only, our sample teacher has a replacement ratio of 87%. In other words, the retirement income target is 87%. So where is this teacher going to get their retirement income from in order to achieve these goals? The three sources of income an individual can draw upon in order to finance the retirement income target are government plans such as Canada Pension Plan, Old Age Security or Guaranteed Income Supplement, workforce plans such as STRP, or personal savings such as RSP, TFSAs, or other personal investments. Going back to our sample teacher, they have determined that they need $50,000 of gross income in order to achieve their retirement goals. Although each teacher's circumstance will be different based on service and salary, we have assumed that our sample teacher would receive $15,000 of retirement income from all government plans. This leaves them with having to fund an additional $35,000 to meet the retirement income target of $50,000. Based on this individual's most recent annual statement, they are estimating to receive $30,000 from their STRP pension plan. With government and workforce plans covering $45,000, this individual will need to find savings to cover the shortfall of $5,000 per year. So what tools can this member use to determine whether or not they are on track? The STRP Online Pension Estimator is a tool all STRP members can access within the MySTF portal. This tool was designed to help teachers estimate how much retirement income they might expect to have in retirement from the STRP under various retirement date and/or economic scenarios. In order to access the STRP Online Pension Estimator, you first need to log into the MySTF portal. Once logged in, click the Pension and Benefits link at the top of the website. Find the Read More button under Pension Plan and click it. Finally, click the Go to Pension Estimator link and start estimating. In our example, we have assumed that our sample teacher would need to find $5,000 per year to fund the shortfall that was expected. But how much money do you need in your bank account at retirement in order to fund this $5,000 per year? The answer to this question is based on how much interest you expect to earn on your money and how long you expect to live. Both questions can be difficult to predict and become overwhelming very easily. One easy way is to simply multiply the amount you need each year, in our case that's $5,000, by the number 25. In other words, $125,000 would be a rough estimate of what someone would need in a bank account at retirement to cover the $5,000 per year. But why 25 times? Let's assume for a minute that you expect to earn 4% each year on your personal savings. 4% of $125,000 in retirement would earn you $5,000 of interest each year. In other words, you would earn enough interest on your money every year to provide for the additional savings you need to fund the shortfall, and not have to touch your original principal of $125,000. If you expect to earn 0% interest going forward, with $125,000, you would still have enough money to last you for 25 years into retirement, drawing $5,000 per year. But what if you think 4% is too much, or too little? Although 4% per year is a reasonable assumption to make for an investor taking a conservative and diversified approach, what if you think you could do better? For example, what if you expect to earn 5% rather than 4% in the future? Our simplified model still holds true in this case. You just need to change the factor from 25 times to 20 times. There are countless scenarios you could run, but my tip for you is to keep it simple and easy to understand. The STRP will provide you a lifetime pension when you retire, based on your formula which takes into account your earnings and service. But what if you think your STRP pension will not be enough? One way to supplement your STRP pension is through making voluntary contributions to the STRP. Voluntary contributions are optional contributions that active teachers can make to the STRP to help supplement their retirement. Voluntary contributions are kept in a separate account from your regular contributions and grow over time with the rate of return earned in the fund. The advantage of saving additional money in the STRP as compared to saving money outside the pension plan is the low investment management fees charged to the STRP. These low fees are a result of economies of scale due to the significant pool of assets in the STRP. It's important to note that any voluntary contributions you make are not matched by the government. In order for you to take money out of your voluntary account, you must either be terminating or retiring. One great use of voluntary contributions is for purchasing eligible service for such leaves as maternity leaves. In other words, when a member goes on maternity leave and wants to purchase that service once they return to employment, monies within your voluntary account can be used for such purpose. One misconception about voluntary contributions is that they are used to increase your monthly lifetime pension at retirement. This is not the case. When you terminate or retire, the total lump sum of all your voluntary contributions, including interest earned, will be paid out in cash, less withholding tax, and/or transferred to an RSP. Setting up a voluntary contribution account is easy. To get started, you will need to submit a voluntary contribution limit calculation request form to the STRP. You can find this form on the STRP website. It's important to note that the purpose of this form is for us to figure out how much money you'll be allowed to save in your voluntary account in any given year. These limits are imposed by CRA and increase each year. The maximum limit for 2019 was approximately $4,200. Once you have the maximum limit calculation complete, you must arrange for contributions to be remitted either by check, monthly payroll deductions from your employer, and/or RSP or registered pension plan transfers. Spousal contributions are not allowed. Whether it's planning for your maternity or parental leave, or thinking of purchasing service you might have accrued with another employer in the past, there's some important information you should know about the STRP when it comes to buybacks and leaves of absences. First off, let's talk about maternity and parental leaves. One important fact to know is that while you're on maternity or parental leave, you do not contribute to the STRP. With no contributions going into the plan, no service will be accruing to you during this period. However, this service can be purchased at a later date, and as early as the first day you get back from your leave. In order to purchase a maternity or parental leave, you must ensure you have the appropriate RSP room. You can find your unused RSP room by looking at your latest notice of assessment you would have received after you filed your taxes. It's important to note that voluntary contributions can be used to purchase these leaves. As an added bonus to the plan, the STRP covers the interest on all maternity and parental leaves as long as you purchase the leave within 1 year from the date your leave ended. After the 1 year window, interest is charged retroactively to the start of the leave and will continue to be charged in the future. I can't stress enough the importance of buying back this service as early as you can, since the cost increases significantly over time as you approach retirement. In addition to maternity and parental leaves, you might also be eligible to purchase service you accrued with another employer. Additional years of service will help increase your monthly pension at retirement. There are a few different types of services that qualify, all of which are listed on the STRP website. If this is something that interests you, please contact the STRP directly and request the cost to purchase such service. Although I've provided you some tips and tools you can use to help you on your financial journey, hiring a financial advisor can also be very helpful. In choosing a financial advisor, you will want to consider the following. What qualifications do they have? What expertise or experience are they bringing to the table? How are they being compensated? Where are they located? Whether or not they have references or referrals, and lastly, whether an in-person interview is warranted. To help you determine the answers to some of these questions, we have listed some resources you may want to consider. The Financial Planning Standards Council lists all advisors in Canada who have a certified financial planning designation. The Institute of Advanced Financial Planners lists all advisors who have a registered financial planner designation. These websites list a wealth of information that can help you. Choosing the right financial advisor is a personal decision to make, so please take the time to find the right person for you and your family. There are a number of resources at the Federation that can help you. The website contains lots of valuable information about the specifics of each of the pension and benefit plans. If at any time you have questions, please reach out to any one of our professional staff members and they'd be more than happy to help you. As previously discussed, the online STRP Pension Estimator tool can be accessed through your MySTF portal and can help you figure out how much pension you will receive from the STRP. Each year you receive an annual pension statement and semi-annual newsletters, which have a wealth of information on your pension plan. And lastly, throughout the year, the STF hosts a variety of sessions in the province on various topics such as planning for retirement and lifestyle seminars. Some of the key takeaways from today's presentation. Similar to your mental and physical well-being, your financial health is very important. So don't forget it. Depending on your circumstances, you may need to start saving a little more in order to meet your retirement goals. But it's just never too late to start saving. And last but not least, please take the time to prepare a retirement budget to see if you're on track.